Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Friday, March 13th, and in the next few weeks, the Treasury Department is expected to unveil further details about its Public-Private Investment Fund idea, which we will refer to in short here as PPIF. The intent of the PPIF is to help banks rid themselves of their toxic assets so that they will have fewer capital constraints that have curtailed their propensity to lend to a broader base of borrowers. This provision is at the heart of why the stock market reacted so poorly to the financial stability plan announced by Treasury Secretary Geithner on February 10th. Simply put, the market was peeved it did not get specific details about how this toxic cleansing was going to work. All it got from the Treasury Secretary was a pronouncement that different structures for the program were being explored and that input was still being sought from market participants and the public during the program's design phase. One element that is known is that the program will provide government capital and government financing to help leverage private capital in an attempt to start a market again for the real estate-related assets that are at the center of this financial crisis. The irony here is too great to ignore. It was leverage that got the financial sector into this mess, and the government seems to think it will take leverage to get us out of it. It is a practical view, given how cheap some of the distressed real estate assets have become and the potential returns they offer. It is also a view that sounds too good to be true. The government is making a big assumption when banking on the success of this PPIF initiative. That assumption is that the banks holding the distressed securities are going to be willing sellers. We don't think they will be, at least not at fire sale prices. Why would they be if they don't have to be? The banks are, quote, well capitalized according to government officials. What's more is that the government has said it stands ready to offer more capital if the stress tests now being conducted reveal more is needed and capital from private investors cannot be raised. Another sales deterrent for banks is the government's selling point to private investors that they should be able to earn a handsome return with very little risk. In essence, it's another iteration of an income redistribution plan which the current administration is fond of and which banks aren't likely to take kindly to when contemplating their ask prices. Selling distressed assets at below cost means the banks will have to realize the losses, which is going to drain capital. The Treasury reportedly is hoping to entice the banks to go ahead and do just that by coming to the rescue with the capital that is needed to offset the losses. The government believes it will be dangling a carrot there, but it will probably be seen by banks as more of a stick since many of them are not exactly champing at the bit to have the government take an even bigger ownership stake. If anything, they are anxious for the government to have less of a stake. In listening to FDIC Chairman Baer, though, it sounds like banks cannot wait to offload their distressed assets. In an interview with American Public Media's Marketplace radio program, Ms. Baer reportedly said, quote, "We think there is significant interest by many of the banks to have a facility where they can fill these assets, and we think there is significant interest among investors to buy these assets at a reasonable price so there is good upside potential," end quote. Ms. Baer also pointed out that the taxpayer stands to make a healthy profit on the purchase of the distressed assets since, quote, "It is absolutely true that the assets are worth more than the current market conditions assigned to them," end quote. If it is such a sure thing that there is a healthy upside potential for these assets for those owners that possess the benefit of time, we wonder yet again why these banks would be such willing sellers at distressed prices when the government has told them it stands ready to inject more capital to prevent a systemic risk. The thinking is that the banks will embrace the benevolent loss approach, which is to say they will happily take the hit for the good of others, take the additional capital from the government, and get back to lending willingly again. Like we said earlier, the solution sounds too good to be true, not to mention too easy. Aside from the aforementioned sales deterrents, banks will most certainly be inclined to play the waiting game as long as the idea is percolating that a suspension of mark-to-market accounting could occur. For that reason alone, there should be a suspension of mark-to-market accounting announced in conjunction with the details of the Public-Private Investment Fund if the government wants to facilitate a quicker cleansing of toxic assets from bank balance sheets. Then you'd see a more active market for offloading the toxic assets since banks won't have the recalcitrant thought that they have to give up the bank to offload the assets to private investors. To be sure, much is riding on the PPIF idea. Treasury Secretary Geithner needs to get his do-over right. We think a suspension of mark-to-market accounting is a key component that would lend credibility to the idea that PPIF is a workable solution that could produce some quick results. Without it, we may witness the unintended consequences of the government's capital assistance program, which is going to ensure key banks stay in business on the one hand, but stand in the way of helping them get back to business as usual on the other. I'm Pat O'Hare for Briefing.com. Thanks for listening.